Picture a man named Edward Backwell. He is a goldsmith and banker on Lombard Street in London, and in the year 1672 he is facing ruin through no fault of his own. He has done everything right, taken deposits from wealthy clients, lent money to merchants, kept careful records, maintained a reputation for reliability built over decades. He has also, as virtually every significant London banker had done, lent money to the king. The king is Charles II, and on January 2nd, 1672, Charles II announces what becomes known as the Stop of the Exchequer. He suspends all payments on his debts. He owes approximately $1.3 million to the London goldsmiths and bankers. He simply decides not to pay. This is the world that the Bank of England was built to replace. Not a world of dishonest merchants or corrupt financiers, but a world in which the fundamental problem of public finance, the problem that had defeated every European monarchy for centuries, had no structural solution. Sovereigns could borrow, but they could also default, and no lender could ultimately compel a king to pay if the king decided not to. The Bank of England, chartered on July 27, 1694, was the solution to this problem. It was not designed to be a central bank, a lender of last resort, a currency regulator, or an instrument of monetary policy. It was designed to lend $1.2 million to a government that had no other way to get it. Everything else, the console market, the funded national debt, the gilt market, the credibility that allowed Britain to borrow at half the rate France paid, followed from that original transaction, and from the institutional framework that transaction required. To understand why that original transaction mattered so much, you have to understand the military situation that made it urgent. In 1690, at the Battle of Beachy Head, a combined French and Dutch fleet defeated the English navy decisively. France under Louis XIV was the dominant military power in Europe, and England, newly under King William III, after the Glorious Revolution of 1688, was at war with France in what historians call the 9 Years' War. England had no fleet adequate to defend its coasts or its trade. Building one required money, not a modest sum, but an enormous one. And as the Bank of England's own account of its founding states directly, William Paterson was a Scottish merchant and financier who had lived in Amsterdam and absorbed the financial culture of the most sophisticated banking center in the world. The Whistle Bank of Amsterdam, the exchange bank founded in 1609, had demonstrated what a state-backed institution with disciplined management could do for financial credibility. Paterson had a clear model and a precise proposal. A public corporation would be created. Investors would lend a large sum to the Crown at a fixed interest rate. And, in return, the investors would be incorporated as a bank with the right to issue banknotes and conduct ordinary banking business. The bank's charter would give it legal privileges that no private partnership could match. The government's commitment to pay interest would be backed by Parliament, its commitment to levy the taxes needed to service it. The interest rate was 8% per annum plus a service charge of $4,000 per year. Expensive by modern standards, but as the Tontine Coffee House analysis notes, a remarkable improvement over the 14% implied rates on the life annuities that had preceded it. The fact that the subscription was fully taken up in 11 days at a time when the government's credit was described as impossible to use was the first demonstration of what the Bank of England's structure provided. The parliamentary guarantee of interest payments transformed the risk calculation for investors. They were not lending to a king who might default. They were lending to an institution backed by Parliament's taxing power, and Parliament was controlled by the same wealthy men who were making the loans. The alignment of interests was structural, not personal. And structural alignments are more reliable than personal ones across generations of kings and ministers. The first governor of the bank was Sir John Houblon, whose face appears on the £50 note issued in 1994, the bank's tercentenary, a merchant of Huguenot descent whose family connections spanned the commercial networks of London and Amsterdam. He presided over an institution that began operations in rented rooms at Mercer's Hall in Cheapside, moved to Grocers' Hall, and would eventually occupy its permanent home on Threadneedle Street, where it has sat since 1734. The building that occupies that site today, the present Bank of England, known for its blank outer walls and its vast internal courtyards, was built to designs by John Soane between 1788 and 1833, replacing the original building that grew too small for the institution's expanding operations. The blank outer walls were not an aesthetic choice. They were a security measure designed to make the building difficult to assault from the street, a design consideration that became urgently relevant during the Gordon riots of 1780, when a mob threatened the building and a detachment of soldiers had to be posted inside. The bank has had an armed guard every night since 1780. The first test of the new institution came almost immediately. The 9 Years' War required more money than the original $1.2 million, and the bank was asked to raise additional loans. The wars that followed, the War of the Spanish Succession from 1701 to 1714, the War of the Austrian Succession from 1740 to 1748, the the Seven Years' War from 1756 to 1763, the American Revolutionary War from 1775 to 1783, and finally the French Revolutionary and Napoleonic Wars from 1793 to 1815, each required the government to borrow at scale, and each borrowing deepened the institutional infrastructure that the bank had created. As the Wikipedia history of the British national debt records, precisely by 1815, at the end of the Napoleonic Wars, British government debt reached a peak of $1 billion. That was more than 200% of GDP. The comparison with France is, as the ABA Banking Journal analysis notes with unusual directness, the most instructive way to understand what the Bank of England's credibility actually bought. Because the Bank of England always scrupulously met its obligations on time. The interest rate on government debt soon declined to a level far below what France had to pay, as it continued to borrow the old-fashioned way, through the personal credit of the monarch rather than the institutional credit of a parliamentary-backed bank. By the mid-18th century, Britain was borrowing at 3% on consols, while France was paying 5 to 7% on equivalent maturities. This 2 to 4 percentage point differential compounded across decades of war finance into an enormous strategic advantage. Britain could borrow twice as much as France for the same annual interest cost. The fiscal military state that historians Patrick O'Brien and Nuno Palma describe in their landmark research, published in the Economic History Review, was built on this advantage. As their analysis, summarized by the Economic History Society, argues directly, the bank helped the British state reach a position of geopolitical and economic hegemony in the international economic order, contributing to form an effective and efficient fiscal naval state and promoting the development of a system of financial intermediation for the economy. The specific mechanism by which this advantage translated into military power was naval. The Royal Navy was expensive in ways that no pre-industrial state could sustain from tax revenues alone. A first-rate ship of the line required years to build, hundreds of crew members, and continuous maintenance. Naval tonnage, as the CEPR analysis by O'Brien and Palma documents, grew steadily across the 18th century relative to other European powers, measuring Britain's rising fiscal and military capacity. By the end of the Seven Years' War in 1763, Britain had effectively defeated France as a naval power in North America and India simultaneously, something that would have been impossible without the sustained credit provided by the bank and the bond markets it had fostered. As Roger Morris writes in The Foundations of British Maritime Ascendancy, drawing on the archival record, the security created by the integration of the bank and state functions permitted the British government to raise very large sums at relatively low rates of interest. The ships that those sums bought were the ships that built the empire. But the bank's role was not simply to lend money, it was developing, simultaneously, the financial instruments and market infrastructure that made large-scale lending possible. The consul, the consolidated annuity that formed the backbone of the funded national debt, paid 3% interest in perpetuity and was freely tradable on the secondary market. It had been introduced in 1751 as the Sacred Heart University student analysis of the bank's war finance notes, when the government consolidated multiple existing debt instruments into a single tradable security. The existence of a liquid, transparent secondary market in consols meant that investors could lend money to the government without committing to an indefinite hold. They could sell their consols at any time to whoever would buy them. This liquidity made consols attractive to a much wider range of investors than a non-tradable government loan could have been: pension funds, insurance companies, widows' trustees, foreign investors. And the wider investor base allowed the government to borrow larger amounts at lower rates. The bank was not merely an intermediary in this market. It helped execute the raising of funds as well as paying the interest on the bonds, managing the administrative infrastructure of a national debt that, by the Napoleonic period, comprised millions of individual bond holdings across thousands of investors. The Napoleonic Wars were the bank's greatest test, and the episode that revealed most clearly how far the institution had traveled from its original status as a private bank with a government account. Napoleon, as the CEPR analysis records in a detail that illuminates how widely the bank's role was understood by contemporaries, obsessed with how the Bank of England was helping Britain during the Napoleonic Wars. A famous 1803 caricature by James Gilray shows Napoleon feasting with his officers on a table set with models of British institutions, the Tower of London, St. James's Palace, a bishop, with the Bank of England conspicuously at the center of the feast. Napoleon understood correctly that the Bank of England was not merely a financial institution, it was a weapon. Its ability to mobilize British savings, manage the funded debt, maintain price stability through the wartime paper money suspension, and provide the short-term liquidity that kept the Royal Navy supplied and Wellington's army paid in Spain. All of this was as important to British military capacity as the cannons of Trafalgar or the squares of Waterloo. A detail that illuminates how widely the bank's role was understood by contemporaries, obsessed with how the Bank of England was helping Britain during the Napoleonic Wars. A famous 1803 caricature by James Gilray shows Napoleon feasting with his officers on a table set with models of British institutions: the Tower of London, St. James's Palace, a bishop, with the Bank of England conspicuously at the center of the feast. Napoleon understood correctly that the Bank of England was not merely a financial institution. It was a weapon. Its ability to mobilize British savings, manage the funded debt, maintain price stability through the wartime paper money suspension, and provide the short-term liquidity that kept the Royal Navy supplied and Wellington's army paid in Spain. All of this was as important to British military capacity as the cannons of Trafalgar or the squares of Waterloo. The gold suspension of 1797 was the episode that most sharply tested whether the bank's credibility could survive severe stress. In February 1797, as a French invasion force, which had actually landed briefly in Wales, spread panic, depositors began running on the bank to withdraw gold. The bank's gold reserves were dangerously depleted. Pitt the Younger, who had been meeting with the bank's directors through the night of February 25th, issued an order in council on February 26, 1797, suspending the bank's obligation to convert its notes to gold on demand. The suspension was described as temporary. It lasted 24 years, until 1821. During those 24 years, the bank issued paper money without the gold backing that its founding charter had required, managing monetary conditions through the most costly war in British history without collapsing into hyperinflation. By the time of Waterloo in 1815, as the Cambridge Journal of Economic History documents, the price level had risen 22.3% since 1797, significant inflation by peacetime standards, but a fraction of the monetary collapses that had occurred in France under the assignat system of the Revolutionary period, or in the Confederate States during the American Civil War. The gold suspension of 1797 was the episode that most sharply tested whether the bank's credibility could survive severe stress. In February 1797, as a French invasion force, which had actually landed briefly in Wales, spread panic, depositors began running on the bank to withdraw gold. The bank's gold reserves were dangerously depleted. Pitt the Younger, who had been meeting with the bank's directors through the night of February 25th, issued an order in council on February 26, 1797, suspending the bank's obligation to convert its notes to gold on demand. The suspension was described as temporary. It lasted 24 years, until 1821. During those 24 years, the bank issued paper money without the gold backing that its founding charter had required, managing monetary conditions through the most costly war in British history without collapsing into hyperinflation. By the time of Waterloo in 1815, as the Cambridge Journal of Economic History documents, the price level had risen 22.3% since 1797, significant inflation by peacetime standards, but a fraction of the monetary collapses that had occurred in France under the assignat system of the Revolutionary period or in the Confederate States during the American Civil War. The bank had managed a paper money regime through an existential national crisis and emerged with its credibility intact, a fact that was itself the most important testament to the institutional depth it had developed since 1694. The 1844 Bank Charter Act formalized what the bank had been becoming for a century and a half. As the Everything Everywhere analysis of the bank's history describes precisely, the currency school won a decisive victory with the Bank Charter Act of 1844, one of the most important pieces of financial legislation in history. The act separated the bank's functions into two departments: an issue department that could only issue banknotes backed by gold, and a banking department that conducted normal commercial operations. It also gave the Bank of England a monopoly on note issuance in England and Wales, gradually phasing out the ability of other banks to print money. With this act, the Bank of England ceased to be a private bank with public privileges and became, in function, if not yet in formal legal status, what we would today recognize as a central bank. Its nationalization in 1946, when the government purchased the bank's outstanding shares and took formal ownership, was in a sense merely the legal formalization of a reality that had existed since 1694, that the institution on Threadneedle Street was above all other things, the state's bank serving the state's purposes, managed for the public interest, whether or not it was publicly owned. The original $1.2 million loan of 1694 was never fully repaid. Edward Backwell, the goldsmith who lost $295,972 when Charles II stopped the exchequer, was ruined because he trusted a king who had no institutional reason to keep faith. The Bank of England was the institution built on the insight that kings default, but parliaments whose members are the creditors do not, and that a bank holding a government as debt and managing a government as accounts has the government as interest, as its own interest, in a way that no individual lender to a sovereign ever quite could. The bank helped Britain defeat Louis XIV, Frederick the Great's enemies, the American colonists, French allies, and ultimately Napoleon himself, not by fighting, but by lending, and by being trusted enough to lend cheaply enough, reliably enough, and at sufficient scale that the ships and the armies and the subsidies to allies that won those wars could always be paid for. Not an ordinary bank, as the historians O'Brien and Palma titled their landmark study, a great engine of state,